Good morning, hello and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremat, and along with me, Karunya Rao. Let's take a look at the headlines for this morning. 11,700 has been reclaimed. PSU Banks, Realty Indexes are championing the upmove. All your sectoral indices are currently in the green. Adani Ports, IOC Coal India are your top gainers. Then looking forward to some earnings today, we have RIL, IOC, UPL, IndusInd, all very important earnings, so keep your eyes out for that one. We then have some stocks which are reacting to earnings impact, Indigo, Blue Dart, Vodafone Idea, Laurus Labs, TVS Motor. Take a look at how all these are performing in trade. Finally, as far as headlines are concerned, the SP Group wants listed Tata Company share in lieu of the Tata Son stake sale. So keep your eye out on that as well. Back to you, Karunya.
Are faring at this juncture. You have the Nifty as well as the Sensex trading flat. We've given up the nominal gains that we were logging in earlier on in the day. Right now, Sensex is trading with a loss of about 83 points. Nifty is also down about 0.1%. Just about that 11,650 mark. But the broader end of the markets are really able to continue their up move. You have the mid-cap index gaining almost 100 points. Small-cap index is also up 0.4%. As far as individual gainers are concerned and sectoral performers are concerned, while earlier in the morning we saw all the indices trade firmly in the green, there has been a bit of a retreating that has taken place from those levels. Nifty Bank is down 0.3%. Nifty Auto is down 0.5%. You have FMCG names and private sector lenders also trading a tad weak. As far as individual gainers are concerned, it's definitely a day when OMCs are really sort of aiding the markets or capping the downside really on the market. You have a BPCL gain about 3.5%. IOC is up 2.6%. Adani Ports, Coal India, Grasim, Ultratech Cement, Nestle, Sun Pharma, these are the top gainers on the index. But on the flip side, you have heavyweights like Bajaj Finance, Maruti, Airtel, Eicher Motors, Kotak Mahindra Bank, all of them losing in the excess of 1.5% each. In fact, Titan and Divi's Labs also looking pretty weak in trade. But if you look at the mid-cap gainers, the ones which are doing or rather outperforming. Okay, before we talk about the gainers as well, let's understand what is in store with the management of BPCL. Varun, why don't you take it away?
Okay, sure, Karunya. We're now joined by N. Vijaya Gopal, who's the Director of Finance at BPCL. Good morning, sir. Thank you so much for taking out the time. What boosted the earnings this quarter? Could you talk to us also about the element of inventory gains that have been witnessed?
Yes, we have performed well both in the refining side as well as in the marketing side this quarter. It was basically driven by the increasing trends in the crude and product prices, though cracks continued to be a concern. But the prices have been on the rise in the quarter from June to July to August. And therefore, we had a lot of opening inventory of crude oil which we purchased at a low price. That has boosted the refining side. We had reported a GRM of $5.8, of which almost $4 is on account of inventory gain. Marketing side, we have done as usual excellently well. The demand has picked up, and second quarter we have almost reached the normal levels of consumption in the country, especially in the month of September. We are reaching October. We are already reached about 100% of the normal consumption of the corresponding period of the last year, October.
Right, sir. And how did the marketing margins fare better than the street estimates? What were the factors?
Second quarter marketing margin is at a normal level. We had slightly higher marketing margins in the first quarter. But second quarter margin levels are on a normal levels. I don't think this is going to either come down or go up as we reach the third and the fourth quarter. It should remain at more or the same levels.
Right, sir. And has demand revival been better than what the street was estimating? What levels are you currently operating at?
Actually, marketing numbers are looking, as in October, as we speak today, the marketing numbers have reached the same levels of the previous 2019 October for both MS and HSD, which are the main products. Now, what we have done is that as a strategy, we have been reducing the throughput and regulating the throughput in our refineries to ensure that we produce to meet the domestic demand. Because, as I was mentioning, the crack spreads on a major products are still abysmally low. And therefore, it makes no sense to produce more and export the products. And we had a higher level of inventory of products in the months of April, May and June because we had to process more crude which was procured in anticipation of normal demand which petered out due to the pandemic. So now going forward, today we are operating the refineries at about 85-87% level. And from the month of middle of October onwards, we are ramping up the throughput. Indecision throughput is not an issue. Both the refineries have taken shutdowns in anticipation of the increased demand. We can go up to 120% level of throughput if required. But I don't anticipate that kind of demand pick up in the third or in the fourth quarter. However, the refinery throughput will ramp up and maybe reach about 90-95% level in the third and the fourth quarter.
Has there been a decision on the block deal of the shares which you were supposed to take by 15th October?
Not yet, Ajay, because further to that, there has been one more extension of the expressions of interest dates to 15th of November. So if there is no further extension, we'll take a call on the remaining portion of the treasury shares. We have transferred already 2% to the ESPS to be given on discount to the employees. Balance 7.33% shares, we'll announce the decision as we close the expression of interest rates and as we reach the RFP.
Could you also tell us how the GRMs fared this time around? Do you see revivals in the GRM cycle or is it too early to say that?
That is a very difficult question to answer. What we have done is that in the second quarter, we had a robust GRM of $5.8. Going forward in the third quarter, we don't expect a very healthy GRM because the crack spreads continue to be a cause of concern. There has been an increase in the GRM for MS, which is about 20-22% of our production. But diesel continues to be a very, very low level of margin, which was about $17 in October of 2019. Now it is only about $3 to $4. So that is a concern. Unless diesel cracks pick up, there cannot be a significant increase on the GRM number.
All right. And, with most of the country now unlocking, do you see demand and volumes for your products picking up meaningfully from here on out?
We have already reached almost normal levels already. See, further, 2019-20 itself was, as you know, a depressed number for diesel as a degrowth of about 3% compared to 18-19 in 19-20. We will definitely reach 19-20 levels of demand in the fourth quarter, even in the third quarter of this year. But further growth in that diesel side will depend on a GDP growth because unless the economy improves, the diesel demand will not pick up to a positive territory. But I'm confident that the third quarter and definitely the fourth quarter of this financial year will have the numbers of demand similar to what was there in the year 19-20.
All right, so thank you so much for taking time out to chat with us. Another heavyweight which delivered its numbers yesterday was Maruti Suzuki. Let's touch base with the chairman, Mr. R.C. Bhargav, joining us right now to talk about the numbers and, of course, the demand scenario, given that festival season is just around the corner. Mr. Bhargav, thank you so much for chatting with us. Talk to us about the demand scenario. What are the lead indicators pointing to right now? Is the recovery more of a result of the pent-up demand, or do you see it sustaining going ahead as well?
The general assessment is that the growth in demand reflects partly the pent-up demand, because there has been a pent-up demand even from 1920. Last year, as you know, instead of growing, the auto sector went down by 18%. And in addition to that, there was a pent-up demand for the current year. So certainly the pent-up demand would have been a factor in the sales taking place at a higher level this quarter. In addition to which, there was the factor of people wanting personal transport and avoiding shared transport, whether it was metro or buses or anything like that. And I think both factors combined. The rural sector has been very good because the crops have been outstanding, monsoon has been very good, and I think the general optimism prevails in the rural sector that things are going to be okay till the next year at least. So those are all positive factors that contributed to the growth of the sales this period now. When you ask for sustained growth, it's very, very difficult to predict what sustained growth will be, because while some of these factors will play out, like the pent-up demand and personal transport requirements and things, the rural demand will still remain strong going forward for some time. But the worry is about the urban demand. Some sectors of the economy are unlikely to grow in the near future to anything like their past rates of performance. Like you take the entire hospitality industry, the entertainment industry, the travel and tourism industry. I think all of them have been very hard hit. And they were fairly large consumers of automobile products. So that's going to remain a negative. The fall in the GDP which we witnessed this year and which will take some time to get back to normal has meant lower per capita incomes. So that reduces the purchasing power. So there is worry on the urban front as to how long the factor of pent-up demand and personal transport will continue. But that is why we are keeping our views open on what will happen going forward after December.
Okay, Mr. Bhargav, does that mean Maruti and OEMs at large will now be chasing the rural demand and would like to tap in more into regions where the penetration is relatively low in perhaps rural, semi-urban, tier 3 type cities?
Maruti has certainly been concentrating on the rural markets, not just this year, but for the last many, many years. And it is a result of that concentration of effort, opening outlets for sale, opening outlets for service, employing local people for sales of cars in those areas, which have resulted in the contribution of the rural market to total sales of about 40%. It's not a small number. And we have achieved this because we foresaw that the rural market was going to become a growing market in the years to come. And we had started this effort some 7-8 years ago. And this is continuing because we continue to open our sales and service network and spare part network in the rural area. I think other companies have also seen the strength of the rural demand, and they will also be spreading out in the rural areas.
Right. So while talking about contribution to sales, we've seen that the share of hatchbacks has gone up to now 62%. Last time when we spoke to you, you were not very sure if the preference towards small cars will become a permanent trend or a long-term trend. Can we expect share of smaller cars and hatchbacks to expand beyond these levels as well, at least over the medium term?
I don't think that we should expect too much of an increase over the current level. Maybe there'll be a small increase. But as you see, this is a very high number. There's also a big market growth in the SUV segment. So that will continue. There's people who are buying the bigger sedans and things. That market is not going to go away. So unless there is a substantial increase in the total demand of cars and the people at the lower end of the market are enabled somehow to buy cars because they become more affordable to them, then I think the percentage may go up. But with the existing conditions as they are, I don't see that there can be too much of a change in that percentage.
Average realization, given that the share of cars priced sub 10 lakh category is about 60% compared to the market level of 50%, do you think average realizations could be under pressure for some time, or there's no concerns there?
But this is not an area of pressure for us at all, because average realization is an outcome of the product mix. And product mix reflects what the customers want. And a manufacturer has to meet what the customer wants. I cannot artificially increase my realization per vehicle by trying to sell vehicles that the customer doesn't want. So I don't think we place too much importance on this average realization and think that this is a pressure point and we must do something about it. No. We follow the market. We follow the consumer.
Right. Hi, Mr. Bhargava. This is also Varun joining into the conversation. You've spoken a lot about the economy taking its own time to get back up and running to the pre-COVID levels. So how would something like a GST rate cut feature right now, wouldn't that actually help propel demand, or do you feel that we're already well secured on that front?
There has to be a supply situation also there. Merely creating demand till there is supply also doesn't make sense, because it will mean a loss of revenue to government. Clear loss of revenue, which is not required at the moment. That is why I've been saying that I'm talking about GST cut, but the GST cut is required in a longer term scenario or a medium term scenario to increase the percentage of growth which we are able to achieve long term. At the moment, I'm talking of now this quarter 3 of the financial year. Till December, I think supply and demand are well in match, and there's no point in increasing the demand at this point of time. But if in the next financial year, I don't know when that may or may not happen, if the demand falls and there is an increasing gap between supply and demand, I think that is the time when the government needs to look at all the factors which are influencing demand, including GST, but that's not the only factor.
Right, so. Well, thank you so much for taking out the time to chat with us this morning on BNSN. Karunya, if you don't have any follow-up questions, let me know.
Mr. Bhargav, thank you so much for chatting with us and joining us this morning. If you could leave us with a comment on how the retails are playing out, just post Navratri and in the run-up to Diwali, what is your projection for sales?
Oh, this Navratri sales have been higher than what they have been in Navratri for the last several years. And that indicates that the Diwali sales should be equally good and better than what we've had in the past. The inquiries are certainly higher. The bookings are pretty steady. And I think all indications are that Diwali sales will be better than what they had been last year and the year before.
That's very heartening to know. Thank you so much, sir, for talking to us this morning. Slipping into a break here, more when we come back. Stay tuned.
Hello and welcome back to Buy Now, Sell Now. It's time to catch up with our experts on technicals and fundamentals. We have Kunal and Vikas both with us. Good morning, gentlemen. Thanks for taking out the time. Kunal, coming to you first. What are your high risk and low risk ideas for today?
So one buy and one sell, and I think one should maintain that kind of a stance in a market which is, such choppy. So the first one is a buy on Cipla. I think that stock is looking somewhat resilient on the pharma front. Many of the pharma stocks, in fact, are looking resilient in the last few days, and I believe that when the markets get into a defensive mode, stocks from the pharma pack, they generally get more buying attention. So I would expect the stock to move up higher from current levels. Targets to be kept at 800 plus. The stop loss could be kept at 740 mark. For Cipla, the second would be a sell on Hindustan Lever. Now it's interesting because the stock has broken below its 200-day moving average. There are some swing breakdowns as well, and swing support levels rather being breached for HUL on the daily chart. So I would expect the stock to go into a downward drift, more of a short-term correction. What I'm expecting from current levels, targets of 2050 and stop loss at 2135.
Okay. Vikas Sethi is also with us. Let's take it across to him for his fundamental calls for the day. Vikas?
Good morning, Karunya. Good morning, Varun. Yeah, as far as my calls are concerned, they are long-term calls and they could be treated as wealth creation ideas. I would like to recommend two stocks, and both are mid-cap ideas from the cash market segment. The first stock is ESAB India. It's an MNC which is a world leader in welding automation and robotics. The company also manufactures PPE and accessories like helmets, gloves, clothing, eye protectors, etc. And these kind of products are in huge demand because of the environment which we are staying in today. This company caters to high growth industries like automotive, power generation, shipbuilding, civil construction, general fabrication. If you look at its fundamentals, they are rock solid. The company operates at an operating profit margin of around 13.9%. The company has a very high return ratios, like ROE would be around 21%, return on capital employed would be around 28%. It's a zero debt company, and if you look at the PAT of the last 3 years, they've grown at a CAGR of 38% over the last 3 years. Promoters holding is around 73%, and FIIs, DIs also hold around 15.5%. So I'm bullish on the stock from a long-term point of view. I would recommend the stock to be bought at the current levels of around 1320, and in the next 9 to 12 months, we could see levels of 1650 on the stock. The second stock which I would like to recommend is again a great company. The name of the stock is Carborundum Universal. It's a Murugappa Group company. It has a joint venture with Carborundum Company of the USA and Universal Grinding Wheel Company of the UK. This company manufactures abrasives, refractories and industrial ceramics. This company also has tremendous growth potential. Fundamentals are pretty good. The company operates at a OPM of around 13%, good return ratios of around return on equity of around 14.5%. A zero debt company, again, strong PAT CAGR over the last 3 years. And the FIs and DIs are also holding around 41% in this company, and they've increased their stake in the last quarter. So everything points to a bullish view on the stock, and I would recommend the investors to be buying into the stock at the current levels of around 275. My targets in a year's time would be 375 rupees on the stock.
All right, Vikas and Kunal, thank you for joining us with your calls for the day for our viewers. Slipping into a break, more updates on the other side. Stay tuned.
You're watching ET Now. We're now joined by a very special management. We have Sanjeev Chadda, who's the MD and CEO at Bank of Baroda. Good morning, sir. Thank you for taking out the time to chat with us. Let's begin with your quarterly result. There's been a sharp bounce back from Q1. That's evident to anyone. The earlier pressures around the cost of funds also seem to be ebbing off. So what were the key variables that played a role to a decent show in this quarter as you see it?
Okay. So I think if you look at the current quarter, I think the key issues have been in terms of the net interest margins, which had come under a little bit of pressure over the last quarter. Our cost of deposits was something which had not fallen in line with the falling yields in a market of declining interest rates. So I think that's something which has changed during the current quarter. Our cost of funds has come down by 53 basis points. So that's something which has really been the biggest factor which is responsible for the improvement in the net interest. On the asset side, the growth has come from the retail book. So unlike the corporate book, where the large amount of liquidity which has been sloshing around in the market has meant that the best rated corporates actually are commanding very, very fine pricing. The retail book tends to give a very steady return. So the fact that our growth in terms of assets has come mostly from retail has helped. Our home loans have grown 13% on organic basis, education loans again by 13%, car loans by 35%. I think that's what's helped keep the yields up. In terms of deposits, the fact that growth came from CASA has been a big help. We reduced our savings bank rate, we reduced our term deposit rates. Despite that, YOY, our CASA has increased 12%. Retail term deposits have increased 9%. So I think the key highlight in my mind has been not only the growth, but of growth. The fact that the improvement in cost of funds has come from a larger CASA deposit, the fact that the improvement in loans has come from retail loans. I think that's, to my mind, is a key as far as we are concerned of the current quarter. The second point I would like to emphasize is that there's been a very sharp rebound as compared to Q1. While we have had a YOY improvement, which in itself to my is significant given the times that we live in, on a YOY basis, the operating profit is up. But I think the rebound from the first quarter is what is really important. Our recovery, our fee income that had taken a big hit in the first quarter because of the lockdown, that has rebounded sharply. Even in terms of our loan disbursements, there's been a big improvement. In fact, our loan disbursements and our loan sanctions in Q2 are higher than they were in Q2 of the previous year. And this is despite the fact that a significant impact on the economy still persists. So overall, I think there's reasonable amount of satisfaction in terms of the improvement we have seen as compared to the first quarter of the year.
Right, sir. And the provisions have been significantly stepped up. So, could you share your thoughts on the current coverage ratio? How well have you provided for the potentially restructured book or book that will require restructuring?
So if you look at our corporate book, that has been really the reason why we have had a few bad quarters, a few tough years in the past. But at the end of it, if we see our provision coverage ratio stands at 85%, which means in terms of what possible impact historical stress could have had on the book, that's largely played out. At the NCLT book, in fact, that's provided up to 90% or more. So when it comes to historical stress, I think we are in a reasonably good place. The question, of course, is what is likely to be the COVID-related stress and how is it likely to play out in the future? So there also, I think we have some room for guarded optimism. So in terms of the RBI dispensation, there's about 14,000 crores of loans which had not been classified as NPAs because of the moratorium benefit which is available. Now, as far as that 14,000 crores is concerned, it could play out three ways. There could be upgradation, and in fact, there has been significant upgradation. There could be restructuring, and there could be some slippages. So currently, as against that 14,000 crores, we hold a provision of 1,700 crores. So if we were to assume restructuring as the central possibility, restructuring requires a provisioning of 10%. So we are more than provisioned for taking care of that book as far as the impact on provisioning is concerned. But having said that, I think we must hold our judgment for till the end of December, by when we will know what accounts have slipped to NPAs, what is the extent of restructuring. But I would only venture to say, in terms of what our prognosis might have been 3 or 4 months back, in terms of how many clients might have requested restructuring, I dare say it's likely to be of a significantly lower order. But then again, we need to suspend our judgment till December and let's see how it goes. But in terms of the resilience of the balance sheet, given the provision coverage ratio and given the amount of provisions we hold against the book, which would have fallen to NPAs but for the moratorium, I think we are reasonable.
All right. Could you also talk to us about your guidance on growth? So while we are largely covered, What is your guidance for FY21 and even 22, if you could give us some projections on growth, profitability and balance sheet strength?
I think we have largely covered what is the likely scenario. We should see cost of deposit remaining very competitive. We should see loan growth to be driven to a large extent by retail and by agriculture in particular, both of which have seen about 16% loan growth. In terms of asset quality, it is tough to hazard a guess in terms of where the restructuring is likely to be. But regardless, I think the bank's balance sheet seems to be strong enough on account of a provision coverage ratio of 85%, and because of the fact that collection efficiency is back to very near normal times and is above 90%.
All right. Thank you so much, Mr. Chadha, for joining us and talking to us about Bank of Baroda's numbers and the way forward. Let's quickly pull up the market as well, the benchmark indices, because they seem to have plunged to the day's low. You have Nifty giving up 11,600 as well. Right now, trading with a cut of 90 points, 11,583 is where it's perched at. Sensex also logging in triple-digit losses to the tune of 350 points. Sensex trading at 39,396, just below 39,400 actually. Even broader markets are back in the red. You have small cap index down 0.2%, mid cap trading completely flat in trade. As far as the losers are concerned, many of them have actually extended their losses, and right now the advanced decline ratio is clearly in favor of the losers. Bharti Airtel down 3%, Bajaj Finance has also extended losses, now down 3%. Maruti trading at day's lowest point, down 3% as well. Kotak Bank, IOC Motors, ICICI Bank, all losing in the excess of 2% each. Divi's, Hero MotoCorp, Infosys, Hindustan, Unilever, Axis Bank, all the heavyweights, especially private sector lenders and several names from Motown, are dragging the markets down. On the flip side, you have OMCs and few names from the FMCG like a Nestle, which are and an ITC, which are trading in the green, lending some amount of support to the market. It's 11:45 on your clock. Let's pull up the buy now, sell now quiz as well. What did we ask you this morning? Let me quickly repeat the question for all the viewers who've just tuned in. Which of the companies make steel products for aerospace and high-grade applications? Options being Bharat Forge, Sunflag, JSW Steel as well as Kalyani Steel. So yes, we have a lot of champions today who have correctly answered this particular quiz. I'm just trying to retrieve the names of those champions. Okay, there you have Nagesh, Akshay as well as Ashok Madrecha who have correctly answered today's quiz question. Thank you so much for all our viewers who have participated in the quiz today. We'll be back on Monday with more questions for you. In case I missed it, the correct answer was Bharat Forge. Just to reiterate to everybody who has tuned in, Bharat Forge is the answer to the quiz question asked this morning. Bharat.
These quiz questions are getting quite tricky nowadays. Fewer and fewer winners. So it's interesting though, they're garnering a fairly good response, I'd say. Along the same lines, quiz question is designed to test our knowledge on the markets of our viewers. We also have Nivesh Ke Funde, which is an ET Now initiative, which is designed toward improving investor education on the markets. So Times Network is always putting your interests first. And in this pandemic, we understand that your personal finances might have been impacted. So we've started a special investor education series that will guide you on growing your financial portfolio. So stay tuned. We're coming back with that just after this break. Hi and welcome back to Buy Now, Sell Now. Let's get you Nivesh Ke Funde, our special investor education series. This is the latest episode. Take a look.
You know, Aisha, I was having a chat with experts on how can everyday investors manage the chop and churn or ups and downs or perhaps peak and troughs, bottom line, the volatility in equity markets.
Yes, I can imagine a lot of investors having that concern. So how should one manage the volatility?
Well, it's quite simple. Think long-term, be patient, and invest via the SIP route in a mutual fund.
You're right. Consistency is the key. In the long term, regular investing really pays off very well, as power of compounding plays a very important role.
Yes, the power of compounding. It is truly magical. What it does, that it really creates wealth in the long term for a patient equity investor.
Yes, Nikunj. After all, equity markets are volatile by nature, and it's this nature of equity markets that actually makes them a source of long-term wealth creation.
And also, Aisha, remember, if you are investing regularly, you are able to bring the rupee cost averaging down, which is there are days you will invest when markets are high. Also, there are days you would invest when markets are low. But in the long term, it will really average out and it will do wonders for your long-term portfolio.
Yes, and over time, the investor ends up benefiting by getting the investments at the average cost of all the SIPs done, thus not having to worry about timing the market at all.
After all, time in the market is more important than timing the market. Hope this edition of Nivesh Ke Funde has helped you gain some insights on how you should go about planning your financial future.
All right, wrapping it up right here on the show. Thank you so much for tuning in.